Last week's inflation data shows us that rate cuts could be coming as early as September, and when we take a look at the S&P over the last 12 months, a lot of stocks have climbed very, very high, making it difficult to find any undervalued stocks. Today's episode, we have managed to find 6 severely undervalued stocks with a lot of upside. Some of these companies we're analyzing, we're talking some very strong double digits. We're going to look at every single one's historical performance. We're going to jump into their dividend safety. We're going to run through a lot of their underlying financial metrics. And ultimately, we're going to get to the valuation part, getting to their intrinsic value, their acceptable buy price, given our own investor margin of safety. And we also want to discuss what Wall Street are looking for over the next 12 months as their upside and their price target. So let's jump into the first stock that we have, and as we said, some of these have some huge upside. The first one that we're taking a look at is Assentia PLC, already a double buy rating, seeking alpha and Wall Street with a hold rating from Quant. As we mentioned, right there towards their 52-week low, it does offer a forward yield of 1.7% and a forward P sitting just under 25. Now, in terms of their performance, well, over the last year, they are up pretty much a devilish number, 6.66%. But over the last 10 years, they are up 281%. As we can see, this doesn't include dividends reinvested, so if we incorporate that, it would be up slightly higher. We can also note it is a little bit away off from the all-time highs of $415 seen at the back end of 2021. So in terms of looking at the metrics, well, the first one is our dividend safety score, 92, very safe, market cap 191 billion. It is a mega cap company. In terms of looking at the dividend safety, it was just reaffirmed the 92 score not too long ago, which therefore shows that a dividend cut does look to be highly unlikely. In terms of the key metrics from the last recession, well, in fact, they increased it during the 07-09 crash. They had negative 11.8% sales, which was pretty much what the average was for the S&P during this period, but they did significantly outperform the S&P, negative 31 when the S&P came in negative 55. What an increase, 15% double digits just last September, 11% on average over the last 5 years, and over the last 10 years, year on year, 10%. We love to see this as dividend growth investors. Now, we do note they have been increasing those dividends for the last 18 years. Very strong. One thing to point out here, though, is in 2019, they did switch from a semi-annual to a quarterly dividend, which is always nice to note. In terms of looking at dividend yield theory, it does state a company is undervalued when the current yield sits above the 5-year average. So we have a sign of undervaluation here. Another sign with the forward P, 24.7, below the rolling of 26.6. Just bear in mind, we don't look at any of these models in isolation and will conclude towards the end. It is also lower than the sector P of information technology that sits at 26.4. Now, in terms of payout ratios, just a general thing to point out on this channel, we do focus on the free cash flow as the earnings is susceptible to manipulation by management through accounting. It also helps us spot any forward-looking dividend cuts. And as we can see, below 60% is our preference, just to give us faith management can offer those lovely double-digit increases we love to see. Well, over the last 10 years, pretty much below, in fact, 40%, 32 expected next year. So the dividend so far based on this data does look very safe. In terms of free cash flow per share, well, it has been increasing nearly 3 times over the longer period. This is a very strong company, and we do want to focus on companies that consistently increase their free cash flow. 2024 expected to go even higher to $16.20. We then take a look at sales growth on this channel. At a minimum, we want 3 to 7%. We do know it is fairly inconsistent year on year. 2021, 2022, some of their best years, strong double digit. 2023, at least keeping in line with what we want. Trading 12 months, though, we can see 2%, so something we should take a closer look at. Numerically speaking, though, they have more than doubled their top line over the last 10 years, 30 billion to 64.1. Shares outstanding, well, nice to note they have returned excess cash to investor pockets, although very marginally, 692 million shares they have bought back, now currently at 638. In terms of the ROIC, return on invested capital, as always, one of my 7 golden dividend metrics, I want to see 10% or more, just to give me faith management can ultimately effectively allocate their capital. Now, yes, it has decreased, but what we note over the last 4 years, still in the very strong 30%, which is very attractive for investors and those who are potential investors searching for a good company to add to their portfolio. In terms of operating margin, well, we want to see above 12%, and they consistently do that. And in fact, operational efficiency noted, going from 14% to 16% over the last 2 years. Also very positive about the free cash flow margin, well above 5% and very consistent in the mid-teens as well. So far this is looking like a very strong company. This just really solidifies what I just said. The net debt to EBITDA, the earnings before interest, tax, depreciation, and amortization. This essentially correlates to dividend safety, balance sheet strength. These numbers that we see below do show us the number of years it would take the company to pay off all of that debt net of cash on hand. Below 3 is our target, and pretty much 0 nearly every single year and into 2024. What this means is that it won't even take them 1 day to pay off all of that debt net of cash on hand. So let's jump into the valuation. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Typically on the channel, we do run through every single one of these models. Today's episode, let's just jump straight into the final calculation. And the intrinsic value here does sit at $386. Now, in terms of the current price, it sits at $303.59. Margin of safety on this channel, we like to start off at 10%, and we only execute if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. So at 10%, if you believe it meets that criteria, it is a buy up to $347. Then we keep going till it's near the current trading price, and we see in today's episode not quite there at a 25% MOS level, but somewhere between a 20 to 25%. In terms of Wall Street and their expectations, well, over the next 12 months, they do see this going up to around $383 as a price target, pretty much in line with our intrinsic value, upside of 26%, so they do believe this is a strong company for the portfolio. In my opinion, as we did just do a high-level review now, it does look like it ticks a lot of boxes and definitely one to consider. But as always, let us know your thoughts in the comments below as we do go along the next 5 as well. We then move on to Gilead Sciences. Now we have a buy rating from Wall Street and a hold from Seeking Alpha and Quant. Again, trading right there towards their 52-week lows. It does have a higher yield than the previous company, 4.55%, and a forward P 18.02 below the S&P of 22. Over the last year, well, down 14%. Over the last 10 years, it is down around 16.3%. But again, if you do include those dividends reinvested, it would be slightly higher. In terms of dividend safety, well, a score of 70, it does look to be safe. Market cap just over 84 billion, a large cap company. And we can see the dividend safety was just reaffirmed last week, with a dividend cut looking to be unlikely. In terms of the last recession, well, they didn't pay a dividend, so no comparative data. Plus 13% recession sales. Remember, the average was negative 12, so that is a big bonus. And in fact, as you go along, if you are someone who watches our videos regularly, this is one of the best stocks that performed in the last recession, plus 4%. As we can see, the S&P had negative 55%. Dividend growth, well, not the greatest, 2.7% just a few months ago, as we do aim on this channel for a minimum of 4% to keep up in line with inflation. Over the last 5 years, a little bit better at that 6% rate. And we do note they have only been increasing those dividends for the last 8 years. Now, in terms of dividend yield theory, we do have the undervaluation signal at 4.55 versus 3.99, but we do ultimately note the forward P is pretty much in line with the 5-year average. However, we can see the healthcare sector as a whole is a lot higher at 16.1. Let's move on to the free cash flow. Well, in fact, for biotechs, to be more specific, below 50%. Gilead Sciences is below that pretty much every single year, although in line in 2023. Nice to note that it is anticipated to come down to 43 in 2024. Free cash flow per share, well, we do note a lot of inconsistencies. It hasn't been increasing over the longer term, but year on year, we do see movements inconsistently. 2024, though, anticipated to go up to 713, so nice to note it is expected to increase over the next 12 months. In terms of sales growth, well, again, 3 to 7%, very, very inconsistent. The last 2 years, we do note, again, pretty much flat. Nice to note, trailing 12 months, it is expected to pick up 2% on that metric. In terms of total sales numerically, then we can see not much growth over the longer term, so definitely one to consider. Doesn't mean it's uninvestable. If you can look at this as a value play, if it meets the criteria, it could be one to consider, and we will get onto the valuation shortly. Whilst it has essentially returned excess cash, if you were an investor from around 2020, they have stopped doing those share buybacks, although they did buy back a very marginal amount over the last 12 months. Now, ROIC for biotechs, we do extend it from 10% to 25%, although we do see over the last 6 years it has been straddling around that level, 23% over the trailing 12-month period. We then move on to the operating margin. Pretty strong margins now for biotechs. It is well above 25%. Yes, we do see operational inefficiency as it has been decreasing. Nonetheless, 36% still very strong. The same to be said for the free cash flow, 28% in 2023, 29% on a trailing 12-month basis. Finally, when we look at the net debt to EBITDA, we do note 1.5 for biotechs, 1.3 in 2023, 1.77, so it is anticipated to increase, hence why we do see the 70 score above of safe, as opposed to the very safe score that maybe we would expect from this company. So let's take a look at the valuation of Gilead Sciences. Don't forget you can grab a copy of this model by clicking on the pinned comment below, so you can get to both the intrinsic value as well as the acceptable buy of companies in your own portfolio or those on your watch list. 10% margin of safety, you buy up to $80, at 15% around $75, at 20% around $70, $80, and at 25%, not quite there yet. So in fact, similar to Assentia, the previous company, it does have around a 20 to 25% MOS level at today's value. How about Wall Street? Well, they anticipate a nice 25% upside. Their price target, $85. Again, not too far off our intrinsic value, so they do see some value here as well. But as always, let us know your thoughts below. Now, before we move on to the next company, just to let you know, we have released our latest free weekly article, 20 undervalued dividend stocks to add to the portfolio. If you want access to this or any others, all completely free, do click on that pinned comment below. This article here, how to find undervalued stocks. If you are someone who wants to know the websites, resources we use, you can find that out and follow along. We then move on to Cisco Systems, a double buy rating, Wall Street and seeking alpha with a hold from quant, trading towards their 52-week low with a forward yield of over 3% at 3.32 and a forward P that looks to be very low at 13. Over the last year, however, very minimal growth, plus 1%. Over the last 10 years, up around 97%, although we can see a few years ago from their all-time highs of $63. In terms of dividend safety, well, 91, we do see another very safe score today. Market cap, $195 billion, a mega cap company. We can also see it was reaffirmed of February this year that the dividend cut is still looking to be highly unlikely. So when we look at the key metrics, no dividend last recession, average growth during the period, and a near S&P return at negative 59%. Dividend growth, well, 2.6% this year, although over the last 5 years looking a little better. Over the last 10 years, double-digit growth. And in terms of numbers, well, they have been increasing those dividends for the last 12 years. In terms of dividend yield theory, again, we can see an undervaluation signal on the yield, 3.32, so higher than the 5-year rolling. In terms of the forward P, though, we do see it's pretty much in line with the 5-year average, although we do see it significantly lower than the information technology at 26.4. Free cash flow payout, no real worries to say here, consistently below 60%, 33 in fact in 2023. Even the increase to 2024 of 45% does indicate a lot of room still for it to go. In terms of free cash flow, positive to note, it has been increasing over the longer term, in fact more than doubled, although we would point out that it is anticipated to drop slightly to around 356 into the next year. In terms of sales growth, well, 3 of the last 10 years negative, although the last year very strong double-digit growth to their top line at 11%, and when we do look at it numerically, it has gone from 47 billion to 57 in 2023. We also note they've bought back more than 1 billion shares outstanding from 5.28 billion to 4.08 in 2023. Now, when we take a look at the ROIC, it is looking very strong. In fact, it has been increasing over the longer term. Just over the last 5 years, we do sit in the mid to upper end of the 20s. So again, very strong, something you do want to consider as one of the key metrics when you do analyze companies. In terms of the operating margin, operational efficiency sitting around 27% over the last 2 years. Free cash flow margin very strong and very healthy. One of the important criteria again to select when you do review companies in your own time. Net debt to EBITDA, even though it has been 0 for the last 10 years and it is anticipated to increase around 0.65 in 2024, it does show why the dividend safety looks to be very safe and does give us a good indicator here that their balance sheet is also very strong. In terms of the valuation then, let's get to it. In today's episode, it is the average of these 3 models, coming to just under $63. So in terms of the current price at $48, a 10% MOS at $57, at 15%, $53.45, at 20%, $50.30, and at 25%, Not too far off the current trading price. So again, pretty much all three stocks so far that we've reviewed, a 20-25% margin of safety. With this, Wall Street's forecast slightly lower than our intrinsic value. They do see 20% upside, and as we said, our MOS sits at just over 20%. We then move on to the next stock, which is Lululemon Athletica. Now we have a double buy rating, seeking alpha Wall Street with a hold from quant. It is pretty much trading near enough to their 52-week low. It doesn't currently pay a dividend, and it has a forward PE of just under 24. Over the last year, they are down around 10%. Over the last 10 years, however, very strong, up 639%. And we can see all-time highs around the $515 mark. In terms of looking at their metrics, then on a free cash flow per share, very strong growth. Yes, very inconsistent. We do note a massive drop from 22 to 23, but then the following year, we do see a huge increase. Even in 2025, it is expected to drop marginally, but still the trend over the longer term is moving in that right direction. Top line sales, well, double digit every single year. This is a fast growing company. Even in the more recent year, 19% is still very strong and healthy. And numerically, we can see here that they have grown around 5 times on that top line over the last 10 years. They have done some share buybacks, although very minimal, very inconsistent, always an added bonus when you do look at very strong companies that do return a lot of that share price to the shareholders. ROIC, lots to love. We're talking in the 30s and the 40s over the last 10 years. The more recent year of 39%, again, lots of potential investors will love seeing this, as this is a very important metric. Operating margin, well, yes, it has increased over the long term, inconsistent, but still above the 16% that we like to see. Free cash flow margin, other than 2023, looking very strong. And for this metric, we do ideally like to see around 5% or more. And when we get to the net debt to EBITDA, as we can see here, from 2020, 0 across the board, expected next year as well. Won't even take them one day to pay off all of that debt. So a very healthy and strong balance sheet. In terms of the intrinsic value for today's episode, it is one that we just believe the DCF model is relevant for. Just under $410 with a current price of $335. Margin of safety at 10%, 369. Then again, we keep going to see what it is in today's episode. Not at a 20% level just yet, but somewhere between a 15 to 20%. In terms of Wall Street and their forecast, well, they see over 40% upside for Lululemon Athletica. Their price target, $473, significantly higher than our intrinsic value. So this is definitely one that they do consider you should be looking to add to the portfolio. Do let us know your thoughts. We have covered this in detail before, so do let me know if this is one you're continuing to add. We then move on to GPN, which is Global Payments, a strong buy. In fact, the highest buy rating from Seeking Alpha, a buy from Wall Street, again, very high, and however, a sell from Quant. It is trading towards its 52-week lows. It does have a forward yield, although it's sitting below 1%, and a forward P that is incredibly low at 9.38. Over the last year, up 5%. Over the last 10 years, up 219%. You do have to go back to around the beginning of 2021 to see their all-time highs around $220. In fact, that is nearly double, or in fact, just more than double the current trading price. Dividend safety score 70. It does look to be safe. Market cap 28 billion, a large cap company. Was reaffirmed just 3 days ago that a dividend cut is unlikely. And when we do look at the key metrics, well, they maintained the dividend during the 07-09 recession, plus 6.5% sales, and they did also outperform the S&P with their negative 38% return. Now, they haven't increased the dividend since 2021, but because they increased it so rapidly, we do see 90% on average over the last 5 years and 17% over the last 20. And we can see they have 0 years of consecutive increases, but they have been paying a dividend for the last 22 without a reduction. Now, dividend yield theory, we get a double severe undervaluation signal on the yield as well as the forward PE. So that is a good starting point. And we also note it is marginally lower than the sector PE of 11.9. In terms of free cash flow payout, well, significantly lower than the 60%, 16% in 2023, 8% expected next year. So if they want to, they can increase their dividend. It just doesn't seem to be a priority. In terms of the free cash flow, they have effectively more than doubled it over the longer term. Massive growth expected into 2024. In terms of sales growth, well, very inconsistent, but some years very strong. 2019, 2020, even the last 3 years looking very healthy. And numerically, when we look at it on a longer term basis, we can see they have pretty much tripled their top line over the last 10 years. In In terms of shares outstanding, well, what they've done is they have diluted your position over the longer term, but what we note from 2020, they have started to do share buybacks. Again, it does depend at which point you did start adding this company, if it is one you do hold. ROIC, not the greatest, not even at that 10% level you want to see. It did drop down to 2% in 2019 and 2020. Nice to note it has started to increase, but I would like to see this up to around that 10% level for investing. In terms of the margins, well, we can see pretty strong from 16% to 23%, so operational efficiency. Hopefully that does continue. And the free cash flow margin pretty much every year, although inconsistent, it is looking very strong at those double-digit numbers. Finally, we get to the net debt to EBITDA. Remember, the dividend safety is 70. It does look to be safe. Below 3. Now, it has pretty much straddled around that over the longer term. 3.55 in 2023, 3.33, so a drop expected into next year. So it does look okay. As we saw on the metrics, it should be safe, especially given the fact that they haven't increased the dividend in a while, and that free cash flow payout does look to be incredibly low. In terms of the valuation, then let's get in. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Margin of safety then pretty good high. Today's episode, as we can see, we can go in 10 denominations, and in today's episode, pretty much a 30% margin of safety. When we do look at Wall Street and their price target, well, similar to a few other stocks, a large upside, 41%, in fact, $154 as their price target. They do believe this is another strong company to consider for the portfolio, and let us know if this is one that you have been adding. A similar company that we did review not too long ago that in fact the hedge funder Terry Smith was adding was essentially Paycom, fairly similar to this, but again, let us know your thoughts in the comments below. We then move on to the next company, which is Ulta Beauty. We have a buy rating from Wall Street, a double hold from Seeking Alpha and Quant. Again, towards its 52-week lows, it doesn't pay a dividend currently, but it has a forward P of 15.03. Down 21% over the last year. Over the last 10 years, we do see up 368%. And we can see all-time highs not too long ago. In fact, this year, February, of $575. In terms of looking at the numericals, well, 2.29, it has in fact nearly 10 times over the long period. Looking very strong, expected to increase next year as well. Looking very good in terms of that free cash flow. Sales growth, we do note pretty much double digit every single year, bar that COVID year. Even 10% in the more recent year, looking very healthy. And we can see their top line has exploded nearly 4 times over the last 10 years. On top of that, they're also doing share buybacks, so lots of value here. 64.7 million, which is already fairly low, to around 49.6 over the last 12 months. ROIC then we see very healthy, double digit every single year. Again, last 3 years looking very healthy in the high 30s, low 40s. Lots to like about this company. Operational efficiency on the margin, although I would like to see this slightly higher, 15% in 2024. Margins pretty much around 5% or more every single year. 9% in 2024 looking healthy. And the net debt to EBITDA, I mean, it's barely above 1 over the longer term. 0.49 in 2024. There or thereabouts in 2025. So looking very healthy across the board. Let's jump into the valuation, and don't forget you can click on the pinned comment below where you can grab a copy of this model so you can get your own intrinsic value and acceptable buy price for companies in your own portfolio and those on your watch list. So a 10% margin of safety for Ulta Beauty in today's episode with the price around $399. 489, so again, very similar to the previous company. There should be some nice margin of safety. Not at a 30% just yet. We can see though between 25 to 30%, and it had a lot of very strong metrics for you to consider. In terms of Wall Street, well, they see 35% upside, $540 price target, pretty much similar to our intrinsic value, so a lot of upside for this one over the next year. As always though, let us know your thoughts. Were any of these companies, pretty much all of them with some significant upside, something you're looking to consider on the watch list? Maybe you already hold it, or maybe for you, it's not just one that you're looking to add. As always, if you enjoyed the content, smash that like button, hit that subscribe and bell button, let us know your thoughts, and we'll see you all on the next one.